2026 will expose who prepared for retirement and who waited too long. Most Americans still think they have time, but the truth is, inflation, debt, and market instability are quietly closing doors right now. What if the biggest mistake isn't losing money, but staying comfortable while the rules change? But here's what nobody tells you. During chaos, a small group always positions early, and one of the strategies they use already created quiet millionaires during the last major downturn. This video isn't about hype or predictions, it's about positioning before the window closes. And once 2026 fully hits, these opportunities won't be available anymore. Strategy 1. AI and Tech Dominance. What if the AI boom already made its winners, and you're about to buy what's left? By the time most Americans feel ready to invest in AI, the real money has already moved, and this is where people permanently fall behind. But here's what nobody tells you. The biggest losses don't come from ignoring AI, they come from entering it the wrong way. Most investors pile into flashy AI stocks after a 200–300% run, buy companies with no pricing power, and hold businesses that won't exist by the end of the decade. That mistake doesn't just hurt returns, it locks you out of the next cycle. In 2026, the money isn't chasing hype, it's flowing into AI infrastructure, data centers, semiconductor supply chains, and cloud platforms, the boring layers that control the future. And if your portfolio is still built for yesterday's economy, the reset won't be kind. Strategy number 2. Dividend and cash flow assets. What if the market crashes, and this time you panic? Not just prices falling, but headlines screaming, portfolios bleeding red, and everyone around you saying sell before it gets worse. This is where most people don't lose money, they lose control. Because in real crashes, it's not numbers that break investors, it's silence. No paycheck, no income, just waiting and fear. But here's what nobody tells you. Dividend income isn't about returns, it's about survival psychology. When the market is collapsing, the investor receiving cash every month doesn't panic like everyone else. They don't refresh charts every 5 minutes. They don't sell the bottom. They compound while others emotionally self-destruct. And in 2026, when volatility spikes faster than most retirement plans can handle, this split will be brutal. Panic sellers versus calm compounders. One group locks in regret, the other quietly buys more. And this matters because the next strategy isn't about income at all. It's about what happens when money itself starts losing trust.
Strategy number 3. Gold and hard assets. What if the dollar quietly loses 20% of its buying power while your savings just sit there? Imagine opening your bank account next year and realizing your $50,000 now buys what $40,000 could yesterday. Inflation isn't just a number, it silently erodes your life's work. This is where most Americans wake up too late. Gold, commodities, and other hard assets don't just survive, they move up quietly while cash holders bleed slowly. Most people only understand this after their buying power is gone. By then, protection costs far more, and regret feels unavoidable. In 2026, smart portfolios hedge early, locking in safety before your dollars vanish into inflation. Miss this, and your secure savings could turn into a cautionary tale.
Strategy number 4. Crypto. Smart, not speculative. What if in 2026 you realize you ignored crypto for the 3rd time? In 2021, people said crypto was dead. In 2023, they said it was too risky. And in 2026, they'll say the same thing again. right before asking why everyone else moved first. But here's what nobody tells you. Crypto didn't punish people who bought late. It punished people who waited for certainty. This is where most people lose money, not in crashes, but in hesitation. When pension funds, ETFs, and governments quietly start buying, that's not speculation, that's positioning. The real mistake isn't buying crypto, it's buying it the wrong way. And that's exactly what most people will still do in 2026.
Strategy 5. Index and low-cost ETFs. What if the reason you're behind financially is because you tried too hard? If you checked your portfolio more than once today, this might sting, because the more most people touch their investments, the worse their results quietly become. Panic selling during red days, buying back after prices jump, chasing the next hot stock because social media made you feel late. This is where most Americans don't just lose money, they lose time, and time is the one thing compounding never gives back. In 2026, the real winners aren't the loud traders. They're the disciplined ones holding S&P 500 ETFs, total market funds, and low-cost index strategies while everyone else reacts emotionally. And if you don't master this now, you won't just underperform the market. You'll slowly fall behind inflation, retirement goals, and people who stayed boring while you stayed busy.
Strategy number 6. Real estate and rental income. What if rent keeps rising, but you buy a property and still lose money every single month? Here's the uncomfortable truth most Americans will discover too late. In 2026, millions will finally buy real estate and realize it's draining them instead of saving them. Rising rents aren't the real danger. The danger is buying a property with a mortgage, taxes, insurance, repairs, and vacancies, and watching your paycheck quietly subsidize it. This is where most people lose money. Fake cash flow built on hope that prices will go up. But here's what nobody tells you. Appreciation doesn't pay bills, and leverage turns small mistakes into financial traps. Smart investors don't ask, will this be worth more someday? They ask, will this pay me every month, even if prices freeze? Miss this distinction, and in 2 to 3 years, you won't just regret it, you'll feel stuck.
Strategy number 7. Skill-based and business investing. What if your biggest asset isn't in the market at all? High-income skills, online businesses, and personal brands are investments too. In 2026, Americans building digital assets, side businesses, and scalable income streams gain unmatched control. This is where most people lose money, depending on one paycheck. If you miss this, regret will follow.
Strategy number 8 to 10. Diversification and timing. Most investors don't fail because they're wrong. They fail because they're late. And by the time they act, even safe bets can turn into losses. Everyone talks about diversification, but almost nobody does it correctly. Dollar-cost averaging works unless you quit at the exact moment the market swings against you. Emotional discipline sounds boring until panic selling erases years of gains in a single day. People made money in AI, crypto, and gold, and still lost it all by panicking at the wrong time. The real secret nobody warns you about: most money is lost during calm markets, not crashes. If you ignore timing, preparation, and proper allocation in 2026, your portfolio might look good on paper, but your actual gains could vanish before you even realize it. By the end of 2026, the gap between prepared investors and emotional ones will be irreversible. Those who act early, stick to smart allocation, and respect timing won't just survive, they'll dominate. Missing this window isn't just a lesson, you'll feel the regret for decades.